Mr. Gruender?
I put it up here.
Okay.
Yes, sir.
There we go.
Let me get this off and then I'll put you up.
Well, thank you all for coming tonight. I'm really honored to see such a group. It's nice when, you know, all you engineers design stuff, and the best thing for a design engineer is to have somebody like his stuff. So, thanks for showing up. Okay, so this is primarily about the advanced new features that are almost live. But Joe said we have some new people here tonight, so I said, but first a quick review. So we have a couple of quick review slides. So that's what the site looks like, and I wanted to point out this little spot right here. For those of you who haven't been to the site yet or aren't coming tomorrow night, about 95% of the presentation tomorrow night can be found by clicking this little button here, which says AAII Seminar, which is basically the seminar that was given to the Silicon Valley AAII group last November. So you can get it all there if you don't get it tomorrow night. Next. So in a SectorSurfer strategy, as you can see on this chart, there's a yellow line, which is the results of SectorSurfer piecing together one ownership after the other of one of these four Fidelity mutual funds here. Click again, please. Okay, I thought there was another thing popping up first, but I guess not. The SectorSurfer strategy is you can select up to 12 ticker symbols to participate in the strategy. Click. I'm sorry, our secret word was next.
Yeah, I understand, correct.
Click is working.
I'm not an engineer, but I understand.
And the job of the algorithm is to extract the trend signal from each of these, because you want to be on the one that's trending the best at any given time. And once another trend takes over in another fund, then you want to move to that trend or surf over to that one. Hence surfing the sectors, as it were. And so the trend algorithm picks which one to own now. And then the system sends you an email trade alert, typically 3 to 5 times a year when there's something to do. There's not a lot of trading in the system. So that's a very short overview. Next. Now, background that I think is important is whether trends really do exist in the market or not. And I found a real interesting thing from this guy, Hurst. And the source for this information is on the site. But there's this guy, Edwin Hurst, who in about 1900 was given the task of building the Aswan Dam for the Nile River. And he thought he should know, well, what's the nature of the water flow? Maybe I should know that so I know how to build the dam. And fortunately, he was in Egypt, where they had 2,000 years of records. And so he assembled all this data and decided to analyze it. And he created this chart, which is referred to as a rescaled range chart. But basically, this is like this is a scale, a log scale, but of the difference between the samples, and this is the difference in the range between those samples. For you engineers, you kind of know that if you're doing a random set of numbers, for every factor of 2, you don't go a factor of 2, you go a factor of square root of 2. It's the random noise thing. If it was a fully linear trend, you go a factor of 2 in time, and you go a factor of 2 in location. So what he found is that when he plotted this stuff, a random line would look like this, but the river flow data looked like that. So there were trending characteristics because if you had a slope of 1 here, that would be your linear slope where the river would rise and always keep rising. And so he discovered this interesting method for determining whether there's trending data within all this random looking stuff. Next slide, please. And there's a I'm missing the guy's name. There's a book by the name of Chaos and Order in the Capital Markets by Peter. Yes. Not Mendelbrot. But anyway, Edgar Peters. Right. And he applied the same stuff to the stock market, to the S&P 500. And the random walk line is shown in blue here, and when applied, then you get this little fall off here, which was showing that for all of these laid one over the other in the 1930s, 40s, 50s, 60s, 70s, 80s, kind of all did the same thing. And the interesting thing about that for me is that it's consistent, whether there's war, whether there's Democrats or Republicans, whether there's new technology. It doesn't care about any of that stuff. And this isn't about going up or down, but it's about how long you go up or how long you go down. And that's about how we as humans create trends. It's how fast we react and change things. The market only moves because we do things or don't do things. So this is a character of us. Next, please. Now also about trends, there's been a number of studies and there's some, you'll see this document online, but the point is here in this article talks about all the different organizations that have had long-term actual trend following algorithms and showing how they did relative to just random market stuff. And so it's been confirmed with large studies that there really is a trend effect there. Next slide, please. And even academia, this is for me a very important document, a paper by this Jagadish and Teagman. And just in summary, they studied all the stocks in the stock market, and their methodology was you take the past 6 months return, create 10 equally weighted portfolios, and have each portfolio held for 6 months. And so with these 10, they divided them according to how they did in the last 6 months. So they have the ones that did well and the ones that did the least well, and use this to decide what to, what to own. And you can see there was a fairly significant difference, an average of 16.8% per year difference in return between the top and the bottom. So even the academics agree. So there's trends in the market. Next, please. So trends, by their very definition, are a portal to the future. Next, please. It means where something in the past tells us a little something about the future. That's what we want to know, a little something about the future. If we didn't know something about the future, it would be random. If it's random, you might as well just go home and put your money someplace and forget about it, because it's not going to help you to think. We're only here because we think we can do something better in the future and we have some kind of a clue. Well, the trend is exactly that. Next, please. So trends are the crystal ball we hope to find. Next, please. And we're not limited to average performance with diversify, rebalance, which is what we're all taught when we grew up. That's what you have to do, diversify, rebalance. Own a little bit of everything, and you can achieve exactly and precisely average results. You can be average like your mother wanted you to be. So maybe we don't have to be average. Next, please. So it's all about reducing noise to reveal the signal, and that's where good old signal processing and engineering come in. And it's unfortunate that the financial studies don't include signal processing. Next, please. So yeah, we want to see a little bit of the road, even if we only partially clear the mud off. It's a good thing because we can kind of see the road. The better we clear that mud, the better we're going to do. Next, please. And then the stuff that we're not going to get into is the way this occurs within SectorSurfer is utilizing match filter processing, which matches just in very short order. If you match, that means you're going to match the shape of your filter to the signal. Because when you match your shape of the filter to the signal, you maximize your signal to noise ratio. So we do that kind of stuff. Then there's differential signal processing. The common mode noise elimination. There's a lot of common mode noise between, let's say, sector funds. The market goes up and down. There's a lot of common mode up and down. You got to process these things together, take the difference between them when you're finding the trends, not the absolute value. You're stuck with a lot of market noise if you do that. Next, please. We're often told that there's this relationship between sectors, market sectors, and economic cycles. And this is a nice chart I found on the web. And it even says what these things are here. But next, please. So as I translate that, then I say, okay, well, these different sectors are doing their things at their different times. And that's a good thing. And so let's make a model of that. You can click again, please. So what if we say each of these sectors is like a piston? And you want the power stroke off of each of those pistons. And the best way then to create a strategy is to not be missing any pistons. You want something with all the pistons, sequential power strokes. Well, they don't even have to be sequential. They can be random in there as long as there's always one going. You're going to ride the sector wave that's doing the best at the time. But one of the things that I'll just mention here, it's a very important thing, but we'll probably not get into it in the other things. But one of the things when you are constructing SectorSurfer strategies, there's some of you probably have noticed there's a strategy online called black gold. And it goes up like this and it goes. This is the problem with it. For a while, all these energy and metals things are doing fine, but you really only have a couple pistons in that strategy. And the period that it's in now doesn't have anything that's giving you a power stroke. I'm leaving that strategy particularly online, because eventually I'll get around to making a point of it on the website. But that black gold strategy is exactly the point of this. It does not have enough of those pistons. Next, please. So a smooth, powerful ride. All pistons are firing, no missing power strokes. Next.